Most investors focus only on stock prices, but the real story starts long before the markets move. The global economy sends signals every single day in interest rates, oil prices, currencies, and consumer data, yet most people never learn to read them. They react to headlines instead of interpreting trends. But here's the truth. Markets don't crash or rise randomly. They follow patterns, and those patterns are shaped by global forces. Understanding them gives you a massive edge, because while the crowd panics, you'll see what's coming. From inflation waves to currency shifts, from central bank moves to trade tensions, every signal is a clue about where money is flowing next. And when you learn to read those clues, you stop guessing and start positioning. Today, we'll break down how to decode global economic signal and how to align your portfolio with the forces that actually move the world's wealth. Because smart investors don't just invest in the economy, they invest ahead of it. 1. Understand the global flow of money. The global economy is an interconnected web. When money moves in one region, it ripples across the world. US interest rates rise and suddenly capital flows out of emerging markets. China slows production, and commodities across Africa and South America drop. Europe struggles with inflation, and the US dollar strengthens automatically. Every shift has a cause and an effect, and investors who grasp this flow can anticipate market direction before it becomes obvious. Smart investors track where liquidity is moving, because when liquidity tightens, risk assets fall, and when it loosens, they rise. Think of global capital as the tide. You don't fight it, you surf it. When you understand where the tide is going, positioning your portfolio becomes less about prediction and more about preparation. In this game, awareness is your greatest weapon, because what you see before others can become your profit. Follow money, not emotion, because money always tells the truth. 2. Watch central banks. The market's real movers. If the global economy had a heartbeat, it would be interest rates, and central banks control the pulse. When the US Federal Reserve, the European Central Bank, or the Bank of Japan makes a move, every market on Earth reacts. Rising rates make borrowing expensive, slowing down growth, and risky assets like tech stocks or crypto usually fall. Falling rates make money cheap, fueling new investment and market rallies. That's why investors track not just rate decisions, but tone, the language central banks use about the future. Words like pause, tighten, or accommodative can spark massive global reactions overnight. Learning to read monetary signals is like reading the weather. You can't stop the storm, but you can prepare your ship. Smart investors position their portfolios based on central bank direction, not speculation. Those who ignore these signals often find themselves blindsided by sudden market shifts, because the market doesn't move on what's happening. It moves on what's expected next. 3. Decode inflation, growth, and employment. Economic data isn't boring, as it's the pulse of the market. Inflation rising? Central banks will tighten. Growth slowing? Rate cuts or stimulus may follow. Employment strong. Consumer spending stays high, and so does demand. Every month, key indicators like CPI, inflation, GDP, growth, and unemployment paint a picture of where the economy is heading. Investors who pay attention can see trends forming months before they hit the news. For example, when inflation cools and growth stabilizes, that's often a bullish setup for equities. But when inflation stays high while growth slows, the dreaded stagflation, it's time to protect capital and diversify. Understanding these numbers helps you connect cause to effect, what's happening and what's likely to come next. Data isn't noise, it's a language, and every investor should learn to speak it. 4. Track commodities, currencies, and bonds. These are the early indicators of market direction, the canaries in the coal mine. When oil prices rise, inflation usually follows. When the dollar strengthens, exports weaken, and global trade slows. When bond yields spike, investors are signaling fear, demanding more return for more risk. Each of these markets moves before stocks do. For example, a falling 10-year US Treasury yield often signals upcoming easing or slower growth, which can boost stocks temporarily. Meanwhile, a rising yield means tighter money and higher borrowing costs, often a warning for overvalued sectors. Currencies tell the story of confidence. A strong dollar often means risk aversion, while weak dollars usually support global equities and commodities. The secret is not to watch them in isolation, but in relationship. Patterns across these markets form the world's financial rhythm. Once you hear it, you'll never unhear it. Smart investors see the world as a system, not a set of separate parts. 5. Position your portfolio strategically. Once you can read the signals, the question becomes, How do you act on them? Start by aligning your portfolio with the global cycle, not against it. In expansion phases, growth assets like stocks and real estate perform well. In tightening or recession phases, defensive assets like bonds, cash, and gold protect capital. Diversification isn't just about owning many assets. It's about owning the right assets for the current phase. Smart investors rebalance regularly, taking profits from overheated sectors and adding to undervalued ones. Global positioning also means thinking geographically. If the US slows but Asia grows, shift some exposure accordingly. If inflation hits hard, consider real assets, commodities, infrastructure, or inflation-protected bonds. Adaptability separates survivors from victims, and investors who can pivot thrive. Because successful investors don't fight macro trends, they ride them. 6. Avoid the noise. Focus on narratives that matter. Financial media thrives on fear and frenzy, but most breaking news is irrelevant to your long-term strategy. The real signals are slow, consistent, and often boring, but that's where real money is made. Focus on fundamentals that truly move markets: interest rates, liquidity, inflation, growth, and global trade. Everything else, ranging from viral headlines to celebrity predictions, is just distraction. Smart investors build frameworks, not forecasts. They use data to guide decisions, not dopamine. Noise fades, but trends endure. And that's where wealth is quietly built. The best investors aren't the loudest, they're the most prepared. 7. Build a global awareness routine. To stay ahead, make global awareness a habit, not an event. Spend 15 minutes a week reviewing global data, central bank meetings, inflation and GDP reports, currency trends, oil and bond movement. Use this information to adjust, not overreact. Stay grounded in long-term trends, not short-term volatility. With consistency, you'll start recognizing patterns instinctively, and what once seemed complex becomes clear. Knowledge turns chaos into clarity, and clarity into confidence. Because the truth is, the global economy always gives warnings before it changes. The only question is, are you listening? The global economy isn't a mystery, it's a conversation. The problem is, most people never learn the language. But once you do, every chart, every rate hike, every policy shift becomes a signal, guiding you towards smarter, calmer, and more confident decisions. Wealth isn't built by guessing the next hot stock. It's built by understanding the forces that shape all stocks. When you can read the signals, you stop reacting to the market and start anticipating it. You move from uncertainty to clarity, from emotion to strategy. So the next time headlines scream chaos, remember, it's not noise, it's information. And information, when understood, becomes opportunity. If this video helped you see the bigger picture, hit like, subscribe, and share it with someone who still thinks investing is all about luck. Because the truth is that it's not luck, it's literacy.